A very warm welcome from Bangkok again. It's 4 minutes past 4 Bangkok time, 1 hour later in our regional colleagues' offices of Singapore and Philippines, and 10 o'clock for our viewers who are joining in and zooming in from the Netherlands. So a warm welcome to you all. Today we have an interesting topic to discuss. I will introduce our speaker, Jelle de Jong, who you already can see in your screen in a few minutes. But before we'll start zooming in on what Lexia Analytics can offer you, the audience, and what Jelle has to share, I would first like to welcome you all on behalf of the ASEAN Dutch Chamber Network, or in short, the ADCN. And if you bear with me for only 2 minutes, I'll quickly brief you on what our collaboration is all about, so you are familiar with what we do in this part of the world. Actually, I'll stop sharing this slide. I'm not going to tell too much about what ASEAN has to offer because most of you know this part of the world, but perhaps it's good for you to know that we are a strategic alliance of 6 collaborating Dutch chambers in the countries Indonesia, Malaysia, Philippines, Vietnam, Thailand, and Singapore. And what do we do? Well, we are hosting this kind of events. We try to share knowledge across peers in the region. We also try to strengthen international connections. We do that across the region. We do that between the bilateral countries, and of course with the Netherlands, which is a bit our home base. We also try to look for opportunities for members. We are a member-driven organization. So most of you are actually members of either one of those 6 chambers. So thank you, special welcome to our members to join, because we like to provide information, relevant information, topical information, which is, I think, also today's webinar all about. And yes, this will also increase network possibilities. Webinar style is, of course, something we have been doing even pre-pandemic, but now when everything is opening up, we prefer enjoying also physical events. So please stay tuned. You will see us also traveling within the region, and you're most welcome to participate in any of these colleagues events. Again, I'll not bore you with this particular slide, but perhaps the next slide is more interesting. These are my colleagues. On the left, you will see the DBEV, which is our friends from the Dutch Business Association Vietnam. Guido, I'm sure you're somewhere in the call. Thank you also for collaborating for this particular webinar. He will offer all kinds of market entry services. Guido is our one of our youngest colleagues, but very active and very dynamic. So I'm very pleased to have Guido in our team as well. We just had our monthly meeting as well. Sander, thank you for joining that particular event. Sander has been active in Indonesia, knows this region also very well. Moving on to Singapore, the ADB Dutch Jam. We have Lotte. You can see a lovely picture of her, another colleague in our region. And the last slide I want to share, Marco Winter. Marco, yeah, we call him the Nestor of our organization. He started many, many years before most of us started. So when you're looking for knowledge or network, Marco mostly is our dictionary. We can always rely on him. So thank you, Marco, also for participating. Then Mitchell. Mitchell was also traveling to Bangkok not too long ago. Thank you for also being very active. He's based in the Philippines for the Dutch Chamber of Commerce in the Philippines. And myself, you'll see on the picture as well. So a warm welcome on behalf of the ADCN. If you would like to be informed of our activities, what we do, please do sign up for our website and for our newsletter. You will see the contact email address and also our website here. So if you already have that in your calendar, that is great. But if not, I'll stay tuned for another 2 seconds to write down the www.adcn.asia. So you can sign up for newsletters and reach out to any of our colleagues. All right, enough about the ADCN. I know you're not here to listen to me or to see my face. We are here to listen to Jelle de Jong. And we are fortunate to have Jelle in our region. He actually arrived 2 days ago, and he's a frequent traveler to our part of the world and knows Southeast Asia very well. He will explain his relationship with this part of the world from previous and current positions he is doing, but he's now going to talk from his company, Lexia Analytics. And yeah, that is the topic I think you all been waiting for. And from the amount of registrations and from the questions received, this is a very relevant topic we will be addressing today. And I had the opportunity yesterday already in a small group here in Bangkok to listen to his presentation and to gain the knowledge. And this is really high level information. So I really encourage you all to put your notes and to put your pens down, because you might have some questions, and questions are also very welcome. But let's first have Jelle talk about his presentation, and questions you can then share in the in the app. So you can send any questions you might have. You can send it to us. So I'll be reading them at the end. I'll come back with any relevant questions for Jelle. I think this is all about what I have to say. It's already 4:09, so we already stole 10 minutes of important speaking time of you, Jelle. I'm so sorry for that, but we are very honored having you here. You're actually only 3 meters away from me, so I will be muting my microphone, otherwise we start singing. And I'll give you the digital floor. Jelle de Jong, there you are.
Thank you very, very much, Hans. I was going to start with saying out loud a real thank you to the Dutch Business Associations. We came a little bit late to the party. We've been in this region for well over 10 years. And we really joined sort of the Philippines, the Malaysia, the Vietnam, and the Thai association recently, and it's been a delight, I have to say. I think it's a real strength for Dutch business to be able to tap into these networks. And I have to say, if I look at what Mitchell did for us in the Philippines, what you've done for us here in Thailand, Guido in Vietnam, you really go beyond the call of duty, and that's very, very much appreciated. I will share my screen to talk you through my presentation. Here we go. You should be able to see my screen now. Just very briefly, something about me. I started my life, his name is Jelle de Jong. You can imagine that I'm originally Dutch. I studied in Delft, joined McKinsey, spent a few years in Amsterdam and a few years in New York, and then joined Diageo. Spent 2 years in group strategy there, living in a wonderful world of frameworks and PowerPoint, not really always that well linked to the real world that was outside. And then I became, for my sins, head of commercial finance for Diageo in Australia, and suddenly I landed in what I would consider the real world. We had a business with 800 million in revenue at the time, gross sales, 600 in net sales, about 150 million in profit. And I found out very quickly that in a business like that, everything in your P&L is actually relatively easy to follow, except that piece between gross to net. 200 million, that to a degree was a little bit of a cowboy country at the time. And I got to sharpen my teeth on that. I did that for 3 years. Then I left Diageo. I think I'd left it for about 3 months, and then I'd moved with my wife to Hong Kong, and then I got a call to say if I was still looking for some independent consulting work, that I could come back. And then I spent another 2 years doing the same thing that I did previously in Australia. I did all over Asia for Diageo, which was a delight. I got paid more, and I had less worries about all sorts of meetings I had to be in and people to manage. So and I could focus on the stuff I enjoyed. We then moved to Singapore, where I set up Lexia Analytics together with Wouter van Rij. I'll get to that. And then I lived there for 8 years, so I know the region very well. Done lots of travel, and then I moved. We set up an office in the UK. Moved there with my family, and took our 2 adopted sons, one from Myanmar and one from Singapore, with us. So we will always have a beautiful link and a lot of gratitude to Asia for that. What I want to talk to you about today is pricing, promotions, and times of uncertainty. And in a weird way, times of uncertainty doesn't really do with credit. It's almost more times of chaos or very high uncertainty. We're living in unprecedented times for most of us, for what we've seen in our lifetime. Very quickly, just so you know, sort of, I'm trying to, oops, here we go. What is Lexia Analytics? Lexia Analytics was started by me and Wouter van Rij. Wouter now manages our Dutch office. I manage the English office, and Yiwa, who's sitting next to me here, actually is managing our Singapore office. We focus really on RGM, and we actually are ridiculously focused because we focus on RGM or for fragmented and developing markets. So really Asia, I mean, we haven't done much work in Latin America, I have to admit, but in Africa, for example, Eastern Europe to a degree, those are markets where we're very strong, and we understand the context much better than, you know, a Tesco in the UK, for example, or an Albert Heijn in the Netherlands. We do two things. We have our own proprietary software, TPM system. We'll talk about that a little bit later because I think it's an important part in these times. And customer profitability cube that we build for customers, still one of the more powerful things to do as a business, I think. And then we just almost as an effect of the fact that we understand this part of the world, part of the business, and in this part of the world understand it quite well. We do a lot of consulting. We do a lot of work on trading terms, pricing platforms, promotional effectiveness, and SAP optimization. Really, that's the core of RGM. Really, we've done that mainly, I should say, in general for consumer goods companies. We've had a few little forays into consumer electronics, pharmaceuticals, etc. But in general, a lot in fast-moving consumer goods, and also in there very often into drinks. So because you know, once you've got a Diageo background, you find out that you end up seeing a lot of those clients more often. Just what is sort of the summary of today's webinar? The first thing is, especially 4 parts to it. In times of high volatility, profit has to be king. You know, I think, and this is not so much just for FMCG businesses, but also for smaller businesses, growth businesses, and all that. Ultimately, this is the time to prioritize profit over revenue growth. There's some interesting research that's come out recently, which actually shows that also those companies really do better. And then if you're going to focus, if you're then going to invest into your customers, you really need to focus on what we now know are the basics of brand growth, i.e., you focus on growing penetration and not by increasing consumption in existing customers. And the nice thing is, at the moment, that's a really good time for it, because in these times people switch much more than they would do in, you know, more moderate, stable times. When you move on headline price, there's a few basic rules of engagement. You know, you want to, it's much better to take 4 increases every 3 or 4 months than to do 1 major increase once a year. There's really also a chance to get your house in order, pack price architecture, anomalies in discounts and terms that you've had from the past. And particularly in the Asian cost context, I'm hoping that I'm not going to hurt too many people's egos here, but then again, we're called Lexia Analytics for a reason ourselves as well. But this is really test and learn tends to beat highbrow analytics in this market much more. And then we'll talk about discretionary spend. I think it's an interesting time from trading terms perspective. Trading terms, to a degree, particularly with major customers, for years were quite stable. You'd rather not touch them than touch them. I think that is changing right now. You can really make some moves there. And it's also, again, the chance to really look at your promotional and discretionary spend. It's also a time to look at the infrastructure that you have behind it. Excel really is a wonderful tool, but it's not necessarily the best tool to manage your databases in. And the last piece that we're going to talk about today is how to organize yourself. This is a war room might be too much, but this is definitely a time to be involved as an executive. There's a lot on the table here. There's a lot at stake. And too often, we find, at least with our clients, there's almost a level of disconnectedness between what's actually being done with customers in the trade and what the executive team is aware of or actively is taking decisions on. And that's okay when you've got a very stable situation. It's absolutely not okay when things are at risk, effectively. However, before we go there, and there were a few questions that were sent up front. I'll deal with most of them afterwards. But there was one question which was went a little bit beyond pricing. Whether will Southeast Asia benefit from a quick economical recovery in the USA, or when in case of Europe? If so, why USA or why Europe? So what's going to happen with the economy? I mean, first of all, I'm not an economist. Probably know just about as much as anybody that reads the Financial Times with a certain degree of interest and has had got sort of you know, an economics background or an MBA. But I think it is important to establish that we really are in extraordinary times. Larry Summers said it very right. He could remember previous moments, probably the global financial crisis, where the gravity for the world economy was similar. but he couldn't remember a moment when there were so many different aspects all happening at the same time. You've got an energy shock, major inflation. Clearly, they're related, but they're not completely linked. Deglobalization. You've got COVID still lingering. There's in major democracies suddenly we wonder whether we can trust the elections, which is scary. There's migration, which is higher than ever before. And there's of course in this week of COP there's the climate. So we do really have some major issues, and I think it's, you know, for most of us, we've never had that in our lifetime. So last time you have to go back to early 80s, and I was a little boy in primary school in those days, so it's a very different time. In terms of what it means for Southeast Asia, I can only give you the things, and I don't want to fall to platitudes, but they're probably well understood, which is regions like Southeast Asia, they tend to rebound always quicker than developed Western economies. You've got much more flexible labor markets here. You've got, to a degree, much more still to catch up with developed markets. So the dynamism in these markets is much higher. So you would expect a much quicker rebound. However, there's also good reason, unfortunately, to believe that this could actually take a lot longer than your average recession. If you go back to the 70s and the 80s, that was a prolonged period. You know, you talk about years of reduced economic activity, where economies didn't grow, particularly not in real terms that fast. And also, this is also the first time for most of us in our lifetime where actually, to a degree, the recession is to a degree self-induced. You know, so the recession is being done by interest rates that are being pushed up because we want to curtail inflation. So there's a very good chance to believe that, although there's no certainties here, of course, but there's a good chance to believe that this is not going to be over in 6 months. This is not going to be over in 9 months. Currently in the UK, they're already predicting that we're going to have a reduced economic activity all the way up until 2024 and potentially well into 2024. That is, you know, that's more than, you know, we would have seen normally in a lot of other recessions. And it's not necessarily clear that we then come out of it, you know, with tires screaming ahead and suddenly we will just go back to 3% GDP growth. So I think it's good to sort of strap in your seatbelts also as a business and to really realize this is different. This is not normal. We've got a lot of things. I mean, I didn't even mention the fact that we're going from quantitative easing to quantitative tightening. So the major banks, central banks across the world, are going to be tightening the money supply more and more because they want to get rid of all the bonds that they have on the balance sheet, or not to replace them when they expire. So that really shows for a little, quite a bleak picture, but it also means it's a crisis you shouldn't waste. You know, it's a crisis that you should use to get everything in order. On that wonderfully optimistic note, let's go into the first part. In times of volatility, profitability should be king. And this was quite interesting. This is work done by two people, Sirin Benafai and Anis Hamelin. It was actually a replication study. So it was done by somebody else already at the University of Queensland. And they took, I think, something like 600,000 even EU companies, and they're basically smaller companies, medium and small enterprises. And they looked at them whether they were focused on growth. They asked them a whole set of questions, or whether they're focused on profit. And then they went back to them a year later and they see how they've done. And what was very interesting in that was, and also a bit, and this was of course done in 2020 somewhere. So this is when there wasn't as much headwind as there is right now. This was the beginning of the COVID crisis, or even a little bit before it. What it showed very clearly was that those companies that really had a very clear idea of their profit and that focused there, they had a much better chance to end up in a better position, or they also had a much better chance to stay where they were, i.e. relatively low growth, high profit. And those companies that actually focused on growth more than profit, they had a very big chance in those times already to actually end up with a much worse position. And I think particularly for those on the call here, which come from small and medium enterprises, maybe even startups, this is really a time to make sure that you know where your money is coming from and where you're earning it, and also what the risks are. I know from personal experience that, you know, it's very nice to calculate a runway of cash that you still have, But then what you can find out is that, actually that runway for cash is a combination of expected revenue and expected cost. And under inflation, what can happen is that both of those go in the wrong direction. And that means that a runway could very quickly shorten rather than lengthen. And then suddenly you're in a situation where you don't want to be. I think this is also very important for businesses to really know their customer profitability. It's something that we started with using access cubes, for example, and VBA code in as long ago as 20 years ago. And it's always been incredibly insightful. What we tend to see with a lot of FMCG companies is that they often have a lot of good data, but it's too much. It's too much to put in Excel. So then you sort of get into sort of derivatives of the profitability. And they haven't expanded our ERP system to include it, also because it's usually a very costly exercise to do so. And it's actually quite strange if you think about it, that if you then ask a lot of our clients, which of your customers are most profitable for each of your brands and during which month of the year, or which deals were the last month were the most profitable, which orders actually were too small to deliver a profit, they very often don't know. And inevitably, if you do that, if you do build the facility to actually be able to track that, it gives you interesting insights, gives you sometimes shocking insights. I remember very distinctly that I once presented it to a client of ours, and I was in front of the exec, and I showed in front of the exec the top 20 of most profitable customers year to date, expecting that they would look at that list saying, yeah, we know this. And then weirdly enough, they knew customer 2 till customer 20, but they didn't know customer 1. So they all looked at each other and looked at who's this number 1 customer. And then thank God the sales director was honest enough to say, actually, I've never heard of this customer. This was a customer that twice a year ordered a container load of alcohol and basically got, didn't need any discount and basically was their most profitable customer, but they never knew it. Very often, what we see here as well is, maybe just explain this a little bit, is what you tend to see with customer profitability, and it's hugely important these times, is Excel is hard to manage these huge amounts of data in, and your ERP is very often too hard to make those changes in easily. So what we do tend to find is companies that actually either have Python or R or anything like that are able to then build simple cubes that they can then investigate in Power BI or even in Excel, extracts from it, to actually track where are we making our money and where are we not making as much money as we would expect. To give you a few examples of that, this was for one of our clients, actually quite some years ago. And what you see here on the left-hand side was basically their brands, and on the right, on the x-axis, effectively, you've got the customers. And what you tended to see there is that when you did this, there were customers and channels that were a lot less profitable than others. And whilst they sort of knew that, when they saw the magnitude of it, and the fact that, for example, the first brand in 7-Eleven was very a lot lower than anywhere else, they could suddenly make they could take some actions. And also, interestingly enough, is to a degree anonymized and not with the numbers. They could share this with some of their clients and say, listen, you cost us so much more per brand than anybody else. We have to make adjustments. But the first thing was to actually know it. Second one here is also, this was for a cement company. They had an average net invoice price, as you could see, of 220. I won't tell the units to give it away, so that would give potentially away. But this was for 1 week. These were all the orders they did in 1 week. And what you could clearly see there is that they had a number of very small orders at the 190, 200 mark for net invoice price, which meant that actually kept the whole invoice price lower than where they really wanted it. And all that happened, and this happened in the space of a few weeks, was the sales director started calling everybody that was in the bottom 10% to say, gosh, could you just explain why you did this deal? No, nobody's going to get fired over it. They just want to know about it. And then the next week he would call again. And guess what? Over time, those lower deals all went disappeared. And in the space of really not more than 3 or 4 weeks, their net invoice price for this particular product, and there were more like this, went up from 220 to 225. Now, clearly, it's not a major space, but it's pure profit, of course, at this stage. And they didn't see any downside to their volume from it at that stage. It's this type of precision, granularity of growth is for example, something that is called as well, where by really honing in on where am I earning it and where am I losing it, where there's really space to go, basically. So first part, profit is king. You really want to know, where am I making my money, where am I losing it at a granular level? Too often in these businesses, of our clients, we're working in averages. We've got average logistics cost. We've got average net invoice revenue. All these averages, and the problem is the danger of these averages that you lose out to figure out, that you lose out the insight where you're making more and where you're making less. And inevitably, when you look at that, there's going to be very profitable customers where actually some of your brands actually aren't doing so well. There's going to be unprofitable customers or much less profitable customers where certain things are really working actually quite well, but they get lost in the averages. And there are some customers where these two come together, and actually both the products and the overall customer profitability is not where it should be. If we then look at the next part, is I've stolen a Paul Krugman quote here, which said that productivity is not everything, but in the end, it's almost everything. And that's a little bit the same thing about brand growth and penetration. We now know, I think everybody has read Byron Sharp's book by now, but we know that there's very clear evidence, and we see that back in the work we do as well, that penetration is really key. That's how you grow a brand, and ultimately when your brand grows, then purchase frequency and all that will go up automatically with it. So if you are going to be investing over the next years, and we all are, of course, because ultimately we're still going to invest with our customers, we're still going to focus promotion on certain things. The focus should be on penetration, on trial. It should be on the smaller packs. It should be on the way that you get people into the category and into the brand, or people that are already in the category into the brand. And it shouldn't be too, and where possible, probably it should be less on the BOGOFs, to buy one, get one free, the major packs that you're just trying to actually almost increase the pantry stocking, etc. It's also time to focus on your distribution. You know, this is a time to sort of look, say, okay, how can we make sure that our physical availability is where we want it to be, or potentially better. And it's probably also the time to not start doing any strange things with packaging and all that type of stuff, but to make sure that your distinctiveness is clear rather than your differentiation. People need to still know what you stand for, need to know what you do, what it does, what it says on the tin. But this is not the time to confuse consumers by going way off piste and saying, you know, we've now got this major insight. I think that's much riskier now. And the good news there is that customers are more likely to switch in these times. So I'm going the wrong way. And so you've got a chance there. You know, there's a real opportunity. This is a piece of work by McKinsey. They basically interview, they do a whole consumer piece of research. I think they do it every 3 months. And they basically asked a whole bunch of consumers, okay, why, you know, you've tried a new brand, what's the main reason? And unsurprisingly, value came up trumps there in almost in every country and also most categories. Value is important, so clearly price is important, value is important. You see that also now in some, you know, I've seen some early scan data in markets like the UK, and what you tend to see there is the own label, private label of major supermarkets, which is now, you know, very trusted as well, seen as to be have a good quality, does very well because it's cheaper than the rest, but it still's got that trusted element to it. And I think you will see that across the board. So there's a chance for switching. It is unfortunately very much value focused. People are, you know, feeling the pinch. But if you are able to position yourself to be in that value range, and you can do that with a good aura of quality, then there is a price to be had there. Okay. Next part, when you move, some basic rules of engagement, and none of this is rocket science. You know, there's always there is a little bit of motherhood and apple pie in these in these lessons. But funnily enough, as we all know, it's like exercise. We all know you should do it, and you should do it probably daily, if not every other day. And I fall foul of it every time, even though I understand that that's what's required. Paradoxically, the first thing, if you start thinking about the price of your product, what's interesting is consumers only know, there's lots of research on this. On average, consumers only know the price of about 20 products. They're sort of hooked in. And I know that, for example, in Asia, for example, some markets like soy sauce, so they can tell you the price of 3 different types of soy sauce. But for a lot of products, they have no idea what the price really should be. I mean, they have an idea, they have a general direction, but it's really not that sensitive. What they do also have a very good idea is what the basket size should cost. So funnily enough, that's almost more of a retailer issue than an individual product issue. So if you're a product owner in a category, the only thing you should really worry about is the fact that you're not get outpriced by your competitor, of course. But actually, in general, the sensitivity to small price increases is often actually not as high as we would like to believe, or particularly if we take price down. This also does mean that consistency is key, however. So what that means is it's okay to take price, but it's not okay to take price in retailer A and not do it in retailer B, because then you really go up against it, basically. I once spoke with a buyer from Australia, very insightful guy, and he said, "Listen, ultimately, I clearly want a competitive offering. I want to make sure I'm getting a good deal. But the only thing that really pisses me off is if I find out that somebody else has got a much better deal." And ultimately these things do sometimes come out, and you can see these. You can see that usually come to a head, particularly if one retailer gets bought by another, particularly if the retailer that gets bought is smaller, and that the bigger retailer then finds out that actually the smaller retailer had better terms than they had. That is definitely not a place you would ever want to be. So I think retailers at the moment, I mean, I've done a lot of work, for example, with the wine company in the UK. I'd say they were unable to take a price increase for 5-6 years. It was with Tesco. It was simply not something that was ever going to be discussed or accepted. It was not something that anybody wanted to have a conversation about. That time has changed. Everybody now understands that you can have a conversation about this and that the pain is such that this is required. It needs to be at some stage relevant and relative to your competition. Clearly, that is a part of that. But at the same time, is also it's almost more importantly that what you do with retailer A also happens with retailer B. Then that's the conversation cannot be had. This also, by the way, comes to a second point, which I wanted to add to this slide, is I find that there can be an awful lot of conversation about price, but actually we're not always that good at tracking what the competitor does. And I think one of the things that really is relevant in this case is to have a competitor dashboard to understand what are the key products that are for each of my products, what's the key competitor product set, what are the 3-4 brands, and to track on a weekly basis. And it's a bit painful, but it's really helpful for the conversation that you're then internally going to have. How are they changing their price? How are they changing their price? How are they changing their frequency? How are they changing the promotional mechanic? Or are they not? I find that really informs the conversation, and I really struggle if it's not there, because ultimately for most products, people are category buyers and not so much brand buyers, much as we would like them to be. So it's incredibly relevant what else happens in that category, particularly with the products that are most relevant to our product. And I think that's something where it really pays off to keep track. Get your house in order. We've all been in situations where we've had a wonderful innovation pipeline. We've launched lots of new products. There's just happened a few things along the way. This is really the time to just sort of, take a breather and say, okay, where are we with all our products? What is our entry pack? What's the price of it? What's the frequency by the upsize, the upscale? Where are we here? And in terms, and to what extent do they all make sense? And I mean, I'd be very surprised if they all make sense in all customers. So this is very often an easy way to say, okay, let's bring this in line. It would also be for me, by the way, a time to look at historical discounts. I'm still to see a customer where if you look at all the discounts terms and all that, particularly with smaller customers, that there's not a few anomalies in there. You think, why are we still doing this? And like I said, this is the time to talk about that. I'm looking at the time. I think we're doing all right so far. Yeah, this is where I hope I'm not hurting too many people's feelings. But as Lexia Analytics ourselves, clearly this is also about us. But data science is really rarely the promise it wants to be in this, and that's particularly the case in Asian markets. Well, I just maybe for how do we define data science? I think it's the cutting point of applied statistics and mathematics. So all the machine learning, the neural networks, all the different applied statistics methods. It's computer science. You need to actually be able to program well, usually in a language like Python or R. And you need to have domain understanding. And this is probably my biggest frustration in this whole field is we have, I see clients and other companies where they have a beautiful data science department. They've got data scientists, a beautiful word, data scientist. Who wouldn't want to be a data scientist? It's just something that looks pretty good, if you can say that. And they can reasonably well program, although even there's a risk always that they're more interested in programming a fancy routine rather than making sure that the data set they're using is not suddenly being sliced in two and that all the analysis happens on a smaller part of the data. And there's very little domain understanding. And I'm still shocked to this day that you can go into a business and that there's a group of people that are called data scientists, and they haven't been out in the trades ever sometimes. And if they have, it's been maybe once or twice, and they sort of got a rough idea of what happens there. I think I mean, this is not just me. There's loads of people in this field who will tell you it's like domain understanding should be one. I'd much rather have a good commercial finance analyst that understands what happens at the sharp end of the trade, that then learns a little bit of statistics and learns how to program in Python, than somebody that comes with a PhD in applied statistics, an amazing ability to program, but really with very little understanding how this consumer goods product gets sold in the Vietnamese market, for example. The bigger problem you also have, by the way, in Asia is that very often you lack real clean and easy data. And actually, this is not even just in Asia. There was once a presentation of the head of data science for Unilever, and I think he had a global role. And he said that his data science team was spending 85% of its time on cleansing and structuring data and only 15% on analysis, and that ratio is actually going backwards. Last but not least, why data science is also a bit at a disadvantage at this stage is a lot of what data science does is extrapolating from the past to forecast what happens in the future. There's a few people that will be shaking their heads and say, well, it's much more than that, but a lot of it comes down to that. If you're coming from a situation where and this is for a lot of developed markets, this is the case, where in the last 5 years, price changes have been minimal, promotional mechanics have been pretty much set, and there hasn't been that much change. And let's be honest, most of these data sources don't go much further than 3 years. And they also then have the weird anomaly, they've got a year or 2 years of COVID in there. It is really hard to see how you can use this data set to forecast what's going to happen in a high inflationary quantitative tightening environment that we haven't seen since the 70s or 80s, basically. So that's why I really would caution here, and if you want to do something in this field and say this is we're really going to use this to help us make big choices, I would be very very clear to make that the domain understanding is crucial there, and even then I would caution you that this is not the biggest promise, and it won't necessarily change the face of your business. So then this is where the motherhood and apple pie comes into a degree, because I find that there are very few businesses that do this very well. And if I'm really honest, when I was in the business, I didn't do it very well either. And actually, I was speaking yesterday to somebody that had been leading, was a vice president for the region for Danone. And this was all he could talk about. This happened in the noughties, 2000 to 2010. They did major tests with Tesco in Malaysia, and it taught them so much. And I think test and learn is really relevant, particularly in a fast-changing environment. And it should become one of those muscles you exercise and get really good at. And not that you start doing it all over the place with 1,000 tests in every 3 months. No, just very focused. You start with a simple workshop as a team and say, okay, across the areas of brand, customer, and competition, what do we know? What do we know? What do we actually really know? We've lost, we've won, we do more promotion, we do less promotion, we know this stuff. Costs are going up, prices haven't gone up so far, those things you know. Then the things, what do we think we know? Actually, and there's a lot of stuff which often starts off in the what we know, and that actually becomes what we think we know, which is really telling in itself. And then to define, what do we really need to know? If we want to make better decisions as a business, what are the commercial questions we would like to answer that would really help us to make better decisions? And you identify every 3 months or whatever the best time frame is for that. You identify the 3 to 5 most important commercial questions, and then you figure out, and how could we find this out? And it's quite interesting because actually, if you put them all together, it's not always as obvious how you're going to find all that out, but because it looks very imposing. But if you say, actually, you know what, the one thing we should find out is how much, and I'm just using a very simple example, is how much more value do we get out of the store where we've got a display next to the cash register, or where we don't have a display next to the cash register? What's the difference? And what you find out, if you pose the question that simple, it's actually not that hard to find 20 independent outlets in the city like Ho Chi Minh, and 20 where you do it, and then find 20 where you didn't do it, and then see the difference between those. And it's very funny because once you do this, you have to be careful, because it becomes, it becomes a man with a hammer that sees a nail and everything, because suddenly you've got a fact. It's not an urban myth anymore. It's not a feeling anymore. It's a fact. You've actually, and then, there's all sorts of things that you can then start researching afterwards, where it's the same in Hanoi, whether it was that, there was sort of a bias because you gave the one store the attention and the other store not. But suddenly you're in a realm of where you're really starting to answer major questions. And if you then can do that together with the retailer as well and show them the results, it can help you in the negotiations with them as well. Another very simple example is, particularly in alcohol companies, for example, you've got an on-premise, you've got major contracts, but it can be the same for pretty much any business that has a B2B business that does major contracts for longer periods. I think we've all been there, where the story internally is that we're losing all these contracts because the competitor is offering so much better terms. But what's a shame about it is that there's actually never a good post-mortem database that actually says, okay, well, how many competitors, how many contracts of the 100 we went after did we lose because of better terms, and how much did we lose because actually they just had a better relationship, or maybe because we didn't come in on time with a new offer. I think this is where diligence and really thinking about what you need to know and how you're going to go about it really helps to sharpen your understanding of the business. Last thing before we go into the last bit on organization, this is really the time to sort of say, okay, I always say, when you're a Smirnoff in Brazil and you've been growing by, or Absolute it was when I looked at it for one of our clients once, Absolute in Brazil, you've been growing by 25% per year, then a lot of the basic stuff just goes by the wayside. I'm growing 25% per year. Nobody tells me what to do. I can pretty much do any deal with any customer. It's always going to look good because I'm growing by 25% per year. If you're not growing by 25% a year, if your category is rather stable, if there's huge amount of cost pressures, but at the same time, it's not that easy to take price, this is a time to really, and that's of course now the case for more of us, where it's, where it suddenly doesn't look as rosy anymore. This is really the time to get your house in order to look at your trading terms, look at your promotional spend, and also to think about the infrastructure. I yesterday gave a whole presentation on trading terms. I won't try to redo that for those that are on this call that were in the room yesterday as well. just very quickly, I think when we talk about trade spend, it's always important, the stuff between gross to net. It's important to acknowledge, first of all, it's a messy area. You've got basically list price inflation. On the one left-hand side, you see the type of customers, your route to market, your distributors, your wholesalers, and then you've got your major chains, the independents. You've got your list price inflation. This price inflation happens to the best of us. In the past, at some stage, we wanted to take price. We took price. We took the list price up, and then we found out it was a bit harder than we were hoping for it to be. And as a result of that, we then started dealing it back. And some businesses have become champions in this. Sometimes you have to do it, like a market like Thailand, where it's almost impossible to take a list price increase. So then you basically want to have some flex in your discount line. But I mean, I've seen extreme cases once for one of our clients in New Zealand, where the total trade spend line was somewhere in the neighborhood of 100 million, and only 20 million of that was real trade spend. The other 80 was pure paper spend, pure inflation. Apart from that, you've got contractual terms, and apart from that, you've got discretionary terms, promotional spend, etc. Now, if I gave this presentation a year ago, then I would have said contractual terms with your major chains, just try not to have to negotiate them. Try to stay away from them. It's a battle of spreadsheets. They have an analyst, you have an analyst, they're clever, you're clever. It's really it's very often hard to see a win-win situation there, particularly if you've got a retailer that's actually going after you because he realizes he's got 6 major suppliers in one category, and he can easily put one on a holiday for a while. The nice thing is this has really changed. You can definitely see an ability now to have a conversation. That doesn't mean that you're suddenly going to have to give less of a rebate, but there is ability to talk about it much more than it has been in the last 3 to 4 years. I mean, like I said, with Tesco, for some of our clients, they haven't had a price increase for 6-7 years, and suddenly they're having price increases. All that's part of your trading terms, and all that's part of a conversation you can have. I think just to give you a little bit idea of what's possible here, I realize this is very FMCG related. I think there's a few situations where it's definitely possible. If you are a commodity tied product, say, for example, a bread producer, and you are tied to wheat prices and all that, and you can clearly show that your product is becoming unprofitable in this retail channel simply because the commodity prices have gone up, it's something that I find that retailers are willing to discuss. They understand, their understanding of that. They're never going to be, welcome you with open arms to say, oh, let's indeed take the price up. But that's a conversation you can have. The second thing, which also I've seen work, is to say, actually, we're going to keep you whole. So you go to for certain retailers, you can say, listen, what I want to do is I want to change the structure of my terms. I want to change the way it all adds up. But the outset of this work, at the outset of this work, we're going to say right now that by the time, if next year you would buy exactly the same compilation of goods and exactly the same ratio of goods and the same volume, you will get exactly the same investment. Having said that, the structure, the way it's built up, is slightly different. That's also one. And the last thing, which we've done a few times with clients, is where they had one major chain that was so much less profitable and had so much higher discounts than the rest, is that we showed an anonymized picture where we basically could show that their bar was so much higher than the rest that this was really, unsustainable for us. And then that was also something where you could definitely have a conversation about, and where in the end we were able to change things. The one thing I always find is, because it's potentially a little bit harder to organize and to set it up, but where I do find that there's, particularly in Asia, major upside, or potential upside, there's never a certainty, of course, but is in the independence, the traditional trade. I still find that consumer goods companies don't have the discipline and don't always have the clarity on what they want to ask those different independent retailers and what they're willing to give for it. And I think there's a real chance to get the execution of your brand in the stores of your liking to a standard that's not a given at the moment, basically. And the nice thing, what I found by doing this in Asia, is I did this. I see that Dennis Brown is on the line as well. He was my sales director in Australia in the past. And doing this in Australia was hard work, because yes, they signed a contract and yes, they agreed to certain terms, But then actually 3 months in, they sort of had forgotten about the contract and they changed the store around a bit again. And slowly you were losing that footprint you would agreed with them. In Asia, things could not have been more different. I've done this work in the past in places like Thailand and Vietnam. And what we found there was that retailers were incredibly committed to actually delivering the changes you'd agreed with them. They were very good at doing that. And they were also very open if you then came up and said, actually, this is not completely the way it should be to make changes. And that doesn't mean that everybody did that. There were always going to be a few rogue customers in there. But I think this is in Asia something where you can really make a difference. It does mean you then need to know what makes what difference. So is that display at the counter as valuable as you think it is? Because if you know it is, then you can invest behind it. You can give part of that investment can go to the customer, and you can reap the benefits of that as a result. This is actually quite, this happened around the global financial crisis for one of our Chinese clients. And this is a little bit what you would expect. This, by the way, this was February 2008. I just moved to Hong Kong, and there were people there standing outside of the AIG building asking what had happened to their pension. So this was quite a serious time as well at that stage. What we did there was, this was with independent customers in China, on-premise outlets, I'd say about 600 of them. We changed the trading terms over time, and we went live with them on just after Chinese New Year, I think that was. And what you could see was, yes, we did lose a little bit of volume, but it was also, they were heavy times from a trade perspective. Not everything went the way we wanted it to go. But what we did was we increased our profitability by an enormous amount. We increased our profitability by an enormous amount because we actually invested behind what was important to us, rather than, you know, all the things that that we had invested behind previously. And so it made a significant difference. So I think trading terms in this time, particularly with independent customers, is where there could be a real benefit. Promotional spend, discretionary spend. Whereas I think in developed markets, in general, there's a good understanding of what promotional spend brings. I do find that in Asia, there does tend to be a risk that we do a lot of promotions because we did the same promotion last year, and we'll do the promotion again next year, most likely as well. This was one of our clients. We looked at this a long time ago, actually, but we looked at it. This is Indomaret. It's a big Indonesian retailer. They do monthly promotions there, and if anybody can see a significant promotional uplift, then they're better at analytics than I am, or worse. Because clearly promotion here didn't make much of a difference, and there was significant investment behind it. I think this is a time to remove the veil and basically, okay, look at what it's really delivering, and be very honest with yourself about that. Because I do find, you know, and that doesn't mean you stop doing promotions like these with retailers, because part of the reason to do these type of promotions is to keep the retailer on side. So there's definitely reason, but do it for the right reasons. Realize why you're doing it, and don't lull yourself into an acceptance that this is probably a good promotion if it's not. Other examples there are with one of our clients in Malaysia, was that they had a monthly budget for promotions. So every month they agreed, they did a standard promotion that started every month on the first of the month, and they had a budget for it. And that budget ran out by day 18 or 19. Now, what's interesting is we didn't really see a decline after day 18 or 19 in the sales of it. So that then means that you have to wonder how much this promotion, as it's called, but it's basically a trade discount, how much it's really helping you. Now, again, that doesn't mean that you then, you know, starting the first of the month completely slash it. But, you know, maybe we let it run out after day 17 or day 16 and see if that makes much of a difference. And we found that it didn't. So I think those are the ways to look at your discretionary spend, is not to slash it all together or to do, you know, big things. I think in general, a slow and easy wins the race here. Just go make small incremental changes over time, and make maybe a lot of them over a year's period, but don't try to make brusque movements. It's a much better way to go. One thing that I did really enjoy doing as well here is you know, be also more specific, rather than give the whole trade the same discount. Think about, okay, who should get this discount, and who who should not. This was for different products. We looked at the customer universe. We looked at who were infrequent orderers and who were frequent orderers. And then we looked at how did they individually respond to a promotional deal. And then you can have a different promotional strategy for different segments for that product. And there's very often these things we never get this exact, because actually we just give the whole trade the same promotion, or the whole every distributor can sell it to all customers. But actually very often I find there's a few big suppliers, big FMCG companies in Asia that have fully integrated distributor management systems with their own system, where they can do this at this level, and where it really does help to do that, because you basically lose a lot of the discount wastage, as I would call it. Because why would you waste funds on customers that are not going to be responsive to a promotional deal anyway, or who would have bought anyway? That doesn't mean that, again, that you have to go all out and completely strip it out. It just means you start chipping away at it, and I think that's where the power lies. Now, here we go to one of my pet hates, or pet loves to talk about, which is that, as Gartner so well said, that Microsoft Excel still has more market share than any other system vendor, basically, even though Excel is really not built for this. Managing promotions. I remember walking into a Diageo office somewhere in 2006 or 2007, it must have been, maybe 2008 actually, in Asia, where we had this suggestion of control. Somebody would have some analysts, some stage in the past, had made a Excel template, which we filled out all the promotions, and then we set had a baseline and an uplift, and we looked at it whether it was positive, and then it got signed off, and then it would go to a customer, and it would sign off physically. So it was printed out, signatures on it, would go to a customer. But then actually the moment you start sort of nipping away at it, like, okay, can we see then the overview, and can we see which customer did it? You found out that it all was basically a house of cards. And I've seen that many times afterwards, huge amount, reams of paper and lots of Excel spreadsheets. But the Excel spreadsheet of the Tuesday does not say the same as Excel spreadsheet that's from last Tuesday, and which one is the right, which one was the right spreadsheet. This is really, it's probably one of the things that surprises me the most, that you've got companies spend 100 million in trade spend and do most of this still in Excel and on paper. There's no control, there's no auditable trail really, even though we'd like to think so. This was one of the situations we came across, clearly anonymized numbers, but a GSV of 800 million, NSV 600 million, and a trading profit of 150. And if you look at the P&L, it's quite interesting. Trading terms, they were set up in the system, 4 contracts making up 90% of spend. Really not a big worry. Not something that you worry about from a financial control perspective, and which also was relatively easy to analyze. COGS, well, that's in this situation, COGS were just given by supply. This is what you use for the year, so also not really an issue. You had a unit price, a few other costs on top of it, but general easy to follow as well. Marketing, 150 million, but actually 20 POs made up 78% of the total spend. And as my boss once said to me, a monkey can hit his overheads. If you know how many people were working for you, then that was easy to follow. And then you had 120 million in promotional spend, more than 10,000 different items and promotions across the year, customers and all that. 3,400 of those made up 80% of the spend. And, as the CFO said, is the main source of all the sleepless nights. This is unmanageable if you don't have anything about it. So my suggestion would be, even, and I'm not just, there's loads of solutions on the market, but you should really think about a TPM system if you don't have one. Also because actually it really generates a benefit to the business. In our perspective, a full value of a TPM solution usually takes about 2 years. And you finding out that for developed markets, the benefits are less. Very often it's in forecasting accuracy and those type of things. But in emerging markets, the benefit can be quite significant. For one of our clients, it was well above 10%. And where does it come from? Very, very simple. Almost the same question as what happened with that cement client of ours, where the sales director starts calling up the lowest net invoice price salespeople. that basically approved those deals. Just, you know, transparency and daylight suddenly makes a lot of these things fade away. People start thinking twice about why to do it. It gets very hard over time to keep doing a promotion if you find out every time there was a negative ROI promotion. It helps then if you also have the overall customer profitability. How does this promotion stand in total in relationship to the profitability of this particular customer? Now, I think I'm almost there. I'll rush through the last 2 slides. I get a thumbs up from Hans there. The final thing here is if we accept that these are extraordinary times, and if we accept that pricing and the whole profitable management are an important part of this, you really need to organize yourself for this, and you need to really think, how is we an organization going to deal with this, because this is not business as usual. It just isn't. One of my pet hates, and I'm always surprised by it, is that CMOs and marketing directors often feel that they don't have a say about price, or that they don't get a say about price. This is the Chief Marketing Officer survey done by London Business School. 96% of these respondents are VP level or above, and their whole titles have head of marketing, etc. And if you ask them what is marketing primarily responsible for, it's utterly disappointing to see that 28% only says that pricing is part of that. And I'll be very clear on this. I think marketing owns pricing. I think marketing should be telling us what the price position statement of a brand is. What's the headline? What's the shelf price? What should the promo price be? What's the frequency of promotions we would like to see, and what's the relative price versus competitors? That's something that for your main brands, marketing should be able to tell you, and they should help the organization with that. Now, let's be honest, part of marketing has tried this in the past and then got slapped back and said, yeah, but we need to go after this. This is a good deal. But that's a conversation you need to have, and it's not something that we just need to now accept that that's the case. I think chief marketing officers need to get involved, and they need to know pricing, and they need to own pricing. That doesn't mean that whatever they say will happen, but it does mean that if you want to make a major change, they do have to sign off on that. The other reason why you need to organize yourself for this is, in disruptive times, you're going to get more tension in your organization because there's going to be different incentives. In a lot of businesses, sales is still being incentivized for the sales they make, not for the profit they generate. Somebody that we once worked with in Indonesia had a beautiful quote about her organization. She said that finance and sales are like Tom and Jerry. One is always chasing the other. And I think one of the ways, by the way, to avoid this a little bit is by making the sales force incentivize them on customer or channel profit rather than on overall sales. And that can be a mix of both, of course. But in general, I think that's why we need to get involved. In these disruptive times, there's going to be more tension in the organization, and particularly between these two parties. And if you let that go, that just will simmer, and it's very unproductive. It's unhelpful. Last slide, and then I will leave it for questions. In our business in Australia, we once did this. We had made basically a bit of a war room, and it was very powerful. I think if you're going to set yourself up for success, or sometimes damage limitation, if things are just really, really hard with a rising US dollar and all that can happen. You want to really set yourself up. This is not sending an email around like, can we get a few people aboard and have a meeting? No, this is saying this is something serious. We need to do something about it. We're going to get some guidelines. We're going to time frame. We're going to get a goal for what we want to achieve. We get cross-functional resource. It's very important cross-functional to get marketing, sales, finance, to a degree, sometimes even legal, sometimes supply chain, to talk together. So, okay, how are we going to, what can we do? Where do we see the opportunity? Where does it currently go wrong? That's a wonderful question itself already. Yeah, where are we currently dropping the ball at times? It requires executive engagement, real engagement. Just saying do this and I don't want to hear you come back with any other answer is really not the right approach. These are uncharted waters, so you need to be able to roll up your sleeves and be part of the solution. It's always interesting, are you part of my problem or part of a solution? And I think the executive wants to be part of the solution here, to figure out, okay, this is hard, let's just work through how we're going to do this. And weirdly enough, I always see that it really helps if you actually set aside a room or the facilities for it, where people then work, if it's cross-functional team 1 day a week or 2 days a week or whatever time required, rather than behind their own desk. That doesn't mean they don't go back to their own desk occasionally, but it's good if you get a team together so there's a real feeling of something that you're working on. And then finally, you need to build that around a weekly or a bi-weekly drumbeat. I think that sort of makes sense. That was my final slide. I'm sure you by now are tired of hearing me talk, so I'll hand over to Hans, and then if there's any questions, clearly I would love to take those.
Well, thank you very much, Jelle. That is a lot of information, as we promised you. And I'm not going to say thank you yet, Jelle, because we have received some questions yet, so you're not off the hook yet. A few questions which were sent to us prior to this webinar. And as we also have members coming from various sectors, let's zoom into a question which is from, let's say, a different sector, which we have mostly listened to Jelle. And this one is for a role of dynamic pricing in businesses like Booking.com, airlines. We all know the travel and tourism industry is famous for discounts, especially in the airline sector, the Booking.com, etc., etc. So what's your view on using those kind of tactical prices, promotional prices for this particular sector? Or is that something you rather not get involved with? Or what advice can we learn from you?
You are on mute.
You should be able. Fine, okay. Dynamic pricing for me is the automation of basically of your pricing. And so what you see is in a lot of businesses, particularly of course, it's very relevant for the travel industry, but you also see more and more retailers, particularly online retailers, want to do this. The main reason is yes, we can all think about the top 10 SKUs that we have and then really think hard about the pricing. But if we sell on total, let's say wine companies have 300-400 SKUs that they're selling online, then to have every day think 3 times about the pricing of each of 300-400 SKUs is quite hard. So you actually, dynamic pricing makes a lot of sense. Also, you can take into account a hell of a lot more things, like what's the competitor doing, what are other brands doing at the same time. I think the first thing is you can get lost a bit in the trap of the velocity of those price changes. So the answer should not be the answer to how often should we change our price is how often do you get enough data to make a better decision. So that is very often, for an airline that can be almost on a minute by minute basis, but for a lot of retailers that's not on a minute by minute basis. The thing that I find worst about it all is that very often there's a misconception that dynamic pricing is this magical algorithm that magically will say this is the best price. And I think you need to lose the magic and make sure you really understand the algorithm and make sure it makes sense. Danilo Zatta has written a great book about the revolution of pricing, or the pricing revolution it's called. And he has a few beautiful examples of how dynamic pricing can go completely out of control. Algorithms struggle with certain cliffs, for example. So we, for example, know that if you buy anything that is $49.95, that works better than you sell it for $50.50. So it's something that we know for a long time. And to change a price, for example, from $49.95 to $48.76 just because the algorithm says so is probably not the right thing. So you need to make sure it makes sense. And you also need to make sure it doesn't really run out of control and that you sort of slowly adapt its changes. So there's a wonderful example of a book that was selling for like $11.95, and then there was a competitor, other similar book that was selling for $12.95, and they kept bidding against each other because they somehow it said they needed to be higher than the other, and by the end it was priced for 2.3 million. Clearly it did not get sold. And I think the final thing I'll say about it is, 2 more things to say, is an algorithm doesn't really consider consumer perception either. So yes, in the short term, some price changes might make sense, but if a consumer really comes back. If there are products that take a while to decide on, you need to be very careful with dynamic pricing, because if you see a different price every time, it's the faith in it goes can really decrease very quickly and diminish the value of your product ultimately in the eye of the consumer. A funny example there, for example, is mattresses. Anybody that buys a mattress online, that's nowadays very common. It's heavily considered, hugely researched. People come back 10, 12 times. You really don't want to have that price be something different every time, because it's you really lose faith in the product then. Last thing, by the way, I'll say on this, and now we'll shut up, is the cost data. So with retailers, very often you're not really just looking at the price, but you're also looking at the profitability. But very often the cost data behind this data, is terrible, because all sorts of things get averaged. We do a pick cost per SKU, we do a warehouse cost per SKU. But actually, if you buy 3 SKUs, it's a full pack. If it's 1 SKU, you actually need it's a split pack. Suddenly a lot of different costs, very different cost to actually, rather than just a 3 times more for the 3-pack. So I think that's also a very important thing, to really keep track of your profitability in the light of this dynamic pricing. My most important thing stays with the first. Make sure you understand the algorithm. Good dynamic pricing algorithms very often start an Excel spreadsheet, and then you just use them in your you basically automate them in the dynamic pricing application you use for it. But it's not a black box that magically comes up with the best the best price.
Well, that's a very long answer to a straightforward question, Jelle. Thank you for that. And elaborating also on the mattress example. Actually, a question came in from somebody working, I guess, in the pharmaceutical or healthcare industry in Indonesia. Is that price sensitivity for these particular products, the healthcare industry, pharmaceutical, also not that relevant? Or do you have any examples you can share for this particular sector?
I'll keep it shorter this time. Well, obviously, price sensitivity, particularly, depends a little bit on the market. If it's a payer market, if it's a, markets like Taiwan, where they've got really good public healthcare, the price sensitivity is almost zero, in the sense that the consumer doesn't get less treatment as a result of it. What you do find is that headline price there, of course, is heavily negotiated, and is a very difficult one. I think that there very often, and we've done some work in the past, and also I've spoken to people that do a lot of work here, and is they see very often the value more in the pockets that are below the headline price, delivery charges, minimum orders, all that type of stuff, than in the headline price. So I think there's a lot of. I remember we once looked at a sutures company in the Netherlands, and every department in the hospital had, every time they ran out of sutures or thought they were going to run out of sutures, they basically ordered new ones rather than ordering for the whole. And they all were sent by UPS at the time to that hospital, so that it was obvious how you could make that a more beneficial outcome, both for the hospital as well for the sutures company.
Clear. Thank you very much. Now, coming back to the food industry and the price sensitivity, special challenging times, as the title also of this particular webinar. How susceptible are consumers to switch brands when certain promos are being offered, especially in the food industry? Is that really also in your finding that consumers are switching when promotions are given for, let's say, competitive brands?
Yes, this is to a degree I sort of did already talk about it, of course, in the presentation. These are the times to really think about promotion and help people switch into your brands, much more so than trying to get more consumption out of existing customers. The nice thing there is that these are usually also less costly promotions, funnily enough, because you're not doing the big discount on the major packs. You're really trying to people to get to trial your product. So yes, the answer very simply, this is a time to get people to switch brands. People switch more. Unfortunately, they do switch down rather than up more than in other times. Sorry, the hotel is trying to tell us something. But so yes, there's definitely a chance for switching here. There's more switching happening, and there's a chance for getting these people to switch into your brand, and to make sure that your promotions are focused on that. there was another question here that I saw, which I thought was interesting, is how to increase rates without losing clients. Very good question. I mean, ultimately, this can be a bit of a rock in a hard place, of course. For some customers, for some situations, some industries, and some situations, you need to increase rates because you're not making as money, you're making less money or even no money anymore. And at the same time, you know, your clients are not opening their arms either to say, oh gosh, of course we're happy to pay more. I think there are two major things there. This is particularly on contracts, you know, license agreements and all that type of stuff. Is the first lesson is, and I've felt this the hard way as well, is to communicate, explain things early and clearly. It makes no sense to suddenly just jump to send somebody an email a day before signing the new contract. Say, sorry, our rates have gone up. You know, explain in advance so they get a bit of a heads up. They know that this is coming. To say, actually, you know what, we are having some serious inflationary pressures inside. Our input costs have gone up. We really are going to have to take a significant price increase, and you know, we're 9 months out, so it's not relevant right now for the new contract. But I do want you to know that. And the second thing is, to the extent that you can, you should watch the competition. Very often, you know about what competitors are doing. You know how they are changing their tack. And in between those two, you'll find a happy middle ground. You'll find something which does not make you uncompetitive, and on the one hand, and on the other hand, also, yes, there might be some tension in the relationship, but it will help you. You will be able to get away with it because you've been open and honest, and they understand why.
Great, thanks, Jelle. And moving to data collection, many of the FMCG and other consumer goods, they work through distributors, local distributors. I'm sure most of our members know what the distributors and how the network works. But how do you then get relevant and reliable data? How to overcome this? Because they're probably struggling with getting the data you require as data scientists. How is your view on that?
I mean, the funny thing is, of course, is if there's no data, it's very hard to do really good analysis on it. And it is also different from retail, from FMCG company to FMCG company. Some of the bigger FMCG companies, of course, have fully integrated distributor systems, and they basically have great data. And in my experience, don't always use that very well. I think where to start here is to define what data you would need, and that sounds really simple, but it's still quite clear. Do you need volume or also value data? And you need to know what discounts were given, what frequency would you like to have it, and how much is it worth? What would it be worth? What decisions would you take differently? How would you, just to think, if I have the data, suddenly everything will become clear. Unfortunately, it's a deceptive and something that is nice to think, but it doesn't, very rarely is the case. So it's very, very important to start with the business case. Actually, if we have this data, we could make much more, we could do promotions at a much more tailored level to individual retailers, and it would really make this much of a difference and actually really quantify the value benefit. And once you know the value benefit, you can say, okay, well, how much do we want to go after this? If it really increases your profitability potentially by 20-30%, it might actually be worth to set up a distributor management system if you've got that scale, so that the distributor actually is integrated with you, and then you can also make it, you can have an exclusivity deal with them, that they get a certain territory and all that. You could also find a way of, can you buy it? In the past, I've seen markets where we would actually just put an analyst in, or basically, not even an analyst, but somebody that would be recording all the deals for our product. We paid for that person. We even paid the distributor for that person being there, and we were very clear on what they could and could not. And that person did nothing but, of every invoice that went out, figuring out what was our product on there, what price was it sold at. And sometimes the price was not allowed, just the volume, but it helped enormously. And as long as the retailer, the distributor knows you're not going to steal that data and go past them, you basically, they've got that trust, you can come a long way. But the first thing is figuring out what you need the data for, how much is worth to you, and then figuring out what's the most practical way to overcome the current hurdle for not having it.
Great, thank you, Jelle. And let's move on to the last remaining question before we end up in some kind of karaoke show in this hotel venue. This is actually coming from Karin, and Karin was asking the question for startups. Would you still recommend starting with the TPM system instead of using Excel?
It's a very fair question after my little preaching about it. I think you need to start with what how big is the startup. So if the startup, if we assume that in the worst case scenario you'll save 5% of your trade spend, if to implement any of these systems are anywhere between 250,000 US and you can probably, if you go to Accenture, it can be north of $1 million quite easily. Now that means basically if 5% is basically a lot less than the 250,000, then I wouldn't start on it for now. And then probably your business is so small that actually, and I know that goes against what I said earlier, Excel can do a good job. But the moment your my threshold is the moment you do more than 10 to 20 million in discretionary trade spend, yeah, I think then you should really start thinking about it, particularly if you're growing, because it's just going to help you grow much more profitable and more controlled.
I see we got Karen's cameras switching on. Hi, Karen. Now I can wave to you as well. Your last question, probably you answered it halfly already, Jelle. Is there any research about the following? The question actually is, which KPIs gives you the best indication for future direction? Any particular KPIs?
Which KPIs gives you the best? Yeah, actually, funnily enough, I would say, sorry, I'm hearing myself double. Oh yeah, sorry. It's customer profitability. If your average deal profitability and your customer profitability is going up, or is at least under control, I think that is ultimately the best indication in terms of that you as a business you're still in control of your business. Maybe one other very simple KPI, particularly for an FMCG company in Asia, but actually no, not even in Asia, anywhere, is if we go into a business and we ask them, okay, what are the last 25 promotions you did, and what are the 5 best and the 5 worst, or what are your top 25 customers, and what are how much profit do you make on them, and you don't know that, that's usually not an indication that you're in control of where you're heading, basically. And I think that's, it's all about really understanding at a granular level what's where you're earning your money and where not.
Well, thank you very much, Jelle. It's 5:25 here in Bangkok, 6:25 at our neighbors in Malaysia. I think we can be honest and fair that this was a very informative session, but again, it doesn't stop here because Jelle is most happy to, of course, reach out to you by also sharing presentation slides for all the delegates who participated today. So we'll definitely communicate that information. We would like to thank, of course, Jelle in particular, so a virtual applause, I guess, for our speaker and host of today. I also would like to thank you for your applause indeed. I also like to thank, of course, our fellow colleagues of the 6 collaborating chambers. And of course, you as the members, we work for you, we do this kind of events for you. And where you feel we can support your business and connect you with organizations like Lexia Analytics, Jelle and his team, please do reach out to us. And we are most happy to support you in that venture. So Jelle, again, thank you very much to you and your team. We'll continue in Bangkok for another round of some informative sessions tonight. But I would like to say thank you all in the Netherlands. A very nice morning, a good afternoon, evening for you all in the surrounding countries. And we hope to see and welcome you at the next ADCN webinar in probably a couple of weeks from now. So please stay tuned. Thank you very much. Have a lovely evening. Have a lovely day. Bye-bye.